What's up, everybody? Tuesday, July 20th. What's going on? I did a podcast today. It'll be up on my podcast site tomorrow. I will remind you about that. So, we had somewhat of a dead cat bounce today. Yeah, the market bounced back after a heavy sell-off yesterday, but I don't expect this to go much further on the upside. Actually, I kind of think today was a good day to sell into this rally. I do not see any pickup in the fiscal flows. As a matter of fact, even when you incorporate last week's 14 billion child tax credit payment, flows continue to slow down. The 10-day average of the daily withdrawal, the daily flow, that is trending down again. The year-over-year differential is narrowing again. The year-over-year growth rate is now the slowest for the whole entire fiscal year. So, I mean, I don't see any evidence in the flows of a pickup in the fiscal support. Actually, I see the opposite, that it is, slowly shrinking. And for me personally, I look at that as a negative factor, a negative fundamental factor. I base really everything on these flows, and so they're not trending in the right direction for me. That doesn't mean it won't pick up. Hey, look, we could still get the infrastructure deal. If we get that, that could be huge. But there's other things coming up. I mean, there's the debt ceiling at the end of this month. I've been telling you guys. By the way, if you go back and you watch my videos from months ago, let's talk about this for a second. All right? Like, for example, let's talk about interest rates, the bond yields. You could go back to March when everybody was, all of these smart people, right, were confidently predicting that rates were going to go up. They had to go up. That the Fed was going to have to raise rates. That inflation was blowing through the roof. And I was saying, hold on with that whole thing. Just, back off a little bit. At that time, back in March, I was saying, look at every single curve in every commodity. The term structure was in steep backwardation. In other words, forward pricing in all commodities, all right? It wasn't like it was in one commodity and you could say, okay, that was because of a particular fundamental outlook based on one commodity, whatever, lumber, sugar, copper. No, it was everything. The forward term structure, all the commodities were telling you prices were going to be lower as we go out over the course of this year. I was telling you that back in March, okay? And that's exactly what has happened. I think the last one to break right now is oil, and that's starting to happen. You have the OPEC just came to an agreement on a production increase. We got data today from the API weekly inventory. They saw the crude inventory build for the first time in 9 weeks. Gasoline's building up. We saw distillate demand. Now, really, it peaked out, a few weeks ago. I mean, distillate demand has been trending lower. So, I mean, all the commodity-induced inflation is starting to go away, all right? That's one thing. The other thing I was telling you was like, the Fed kept saying they're not going to raise rates. They're not going to raise rates. They're still saying they're not going to raise rates. I mean, the one meeting they had, what was that, back in May when everybody freaked out because the dot plot, shifted from saying no rate hikes until 2023 to maybe a rate hike at the end of 2022. I said, that's ridiculous. What is that dot plot anyway? I mean, I think they survey the FOMC members. Hey, what do you think, Charlie? Where do you think rates are going to be? What do you think, Jerome? Where do you think rates are going to be? What do you think? And then they plot that. And so it's like it's their outlook. It doesn't mean that is a policy shift. So I said, pump the brakes on that. But that's number one. It was that the Fed was saying they're not going to raise rates. You had all these super serious, smart people, right? They roll them out on CNBC and Fox Business every day saying how rates were going to have to go up. I mean, these people were so frustrated. They were so beside themselves. They were just like, they couldn't take it anymore. Like, why isn't the Fed raising rates? Come on. I mean, they spent the last 20 years telling us, don't fight the Fed. And then there they were every single day on TV saying, fight the Fed, fight the Fed. It's going to go. I mean, come on. That's number one. Number two, as I've been saying all along, you got this massive, historic cash dump into the banking system with the Treasury spending down the TGA and with the Fed still buying $120 billion a month in assets. I mean, this massive cash addition, it just is going to pressure rates overnight down. So like today, I think we got down to 112 on the 10-year note, and then it popped back up to back over 1.2. I think it's at 1.22. I mean, it's going down. Look, there is no reason in the world, I'll go over this again because I've been through this once before. There is no reason in the world why US bond yields are higher than bond yields in Europe when all those countries, particularly the basket case economies of Greece and Italy and Spain, all those countries no longer have currency sovereignty. They're all currency users. Okay, there's infinite amount of more risk in those countries, including Germany, by the way, including France, who let's call those the stronger economies in Europe. Infinite more risk than the United States, which is a currency issuer and can never, ever, ever be involuntarily forced into insolvency. Okay? I mean, nobody could come along, no entity, no country, no company, and force the United States into insolvency because by declaring, hey, you can't meet your obligations. It always can. But in Europe, that can happen. All right? So there's no reason why U.S. bond yields should be above Eurozone bond yields. And I believe we're in a period right now, kind of a historic period, and one that is overdue, in my opinion, where rates are going to converge. U.S. rates are going to converge to European rates. All right? That means the 10-year will go below 1, well below 1%. Now we have the debt ceiling coming up at the end of this month. And it's another thing I've been telling you guys, like, I don't see where we're going to get an extension on that or an increase right away. I mean, Treasury is going to have to operate with extraordinary, under extraordinary measures to make payments like they do every couple of years, like Mnuchin had to do, like withholding contributions into government pensions and stuff like that. I mean, it's just like, that's really the reason, in my opinion, why U.S. bond yields are higher than Europe, is because we go through these cockamamie shenanigans every 2 years with this ridiculous debt ceiling and the threat of not making good on our obligations. I mean, it's shameful. It's ridiculous. But rates are going to come down. But again, everything comes back to the fiscal flows. They're slowing down. I think it's temporary because I think we're going to get an infrastructure deal. We're going to get, additional fiscal response. It's just not going to come right away. So basically, I think we'll see. This could be a setup to a great, great buying opportunity at some point down the road. I'm not saying right now. All right? And like I said yesterday, the only real thing to worry about that would kind of create a scenario of longer term retrenchment in the economy would be if these idiots, and also in the White House, if they say, okay, now because of this, inflation, we're going to switch to some kind of, fiscal conservatism, budget cuts, try to balance the budget, something like that. If we go down that path, forget it. It's over. It's over for a number of years. I don't think we're going down that path. Not in the middle of these negotiations for the infrastructure deal, but we'll see. Anyway, I'll have a lot of this in my podcast tomorrow. You can check it out. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Bye.